weighing machine was created to help you, the financial advisor or investor, reach your long-term financial goals. Each episode, your hosts, Rusty Vanneman and I, Robyn Murray, cut through the market clamor to find the time-tested principles that help investors succeed.
The weighing machine is inspired by the classic investing saying attributed to Benjamin Graham. The stock market is a voting machine in the short term and a weighing machine over the long run. In other words, emotion and expectations drive short-term market movement, but fundamentals and valuations determine returns over time.
Welcome to the weighing machine.
Enjoy, and as always, let us know what you think.
On the podcast today, commercial real estate in a post-pandemic world.
We will discuss the current commercial real estate market and the impact of economic shifts, plus challenges, opportunities, equity versus debt, and much more. That's with our guest, Chen from DoubleLine Capital. Welcome to the weighing machine. I'm Rusty Vanneman.
And I'm Robyn Murray. Okay, Rusty, let's start with a look at the markets. What are you watching out for at the moment?
Well, to timestamp this interview, we are recording in the beginning of March, and there is a lot of stuff going on in the markets and the economy, and some may even be resolved by the time the podcast is published. But a leading concern as of this recording is that of a growth scare. In other words, will economic growth disappoint, if not outright contract? This impacts all the economy, of course, but one area of concern for many is commercial real estate. Commercial real estate is facing a perfect storm of challenges: volatile interest rates, shifting office demand, retail sector struggles, and mounting refinancing risk. With a wave of loans coming due and valuations under pressure, many investors are wondering if we're on the verge of a deeper downturn. Add to that the broader economic uncertainty and the fears of a growth scare, and the big question becomes, what are the opportunities in this environment? To help us break it all down, we're joined today by an expert and a portfolio manager in this space who specializes in commercial real estate and mortgage-backed securities. We'll dive into where he sees value, how investors should be thinking about commercial real estate in this rate environment, and what could be next for this sector.
All right, well, let's bring him in. Chen is a portfolio manager at DoubleLine Capital in Los Angeles. Welcome to the weighing machine.
Thanks, Rusty. Thanks, Robyn, for having me.
Well, first of all, thanks for this interview. We did have this scheduled a couple months ago, but of course, being in the LA area, you were impacted by the fires. So thanks for the postponement. It's glad to hear everything is okay for you and your family. But our very first question could be the hardest question of all. We're going to throw you a fastball right off the bat. And we need a walk-up song to set the tone for this interview.
The walk-up song is Back in Black. And I chose that in December, and I think it's still very, very applicable.
One of the all-time great pump-up songs.
Yep.
Awesome.
Yep, that's a good one. All right, well, Morris, let's talk about your background a bit. You've been at DoubleLine for 15 years. Before that, you were vice president at Trust Company of the West. Tell us more about your career and how you came to your current position.
Yeah, I spent my entire career essentially looking at the fixed income markets, particularly in the credit side. So, starting from TCW, Trust Company of the West, as you kind of highlighted, in the very, very early 2000s, right out of school, focusing on corporate credit as well as commercial mortgage-backed securities. Saw the wave in terms of the global financial crisis, or the years that led up to that, and then the immediate aftermath of the GFC. And from my standpoint itself, in terms of cutting my teeth in terms of background, being in the trenches with Jeffrey Gunlock as well as the rest of the mortgage-backed securities team, I think doles out a lot of scars, but also learning lessons through the crisis, and kind of puts me back into where we are today, right? CMBS is a commercial mortgage-backed securities. Again, it's a flavor of mortgages, and there's also so many different moving parts, and these are things that we're trained as professionals to look at in terms of risks.
Right. Well, tell us more about DoubleLine. So it's an independent, employee-owned firm. Does that independence influence the culture and the thinking at DoubleLine?
It absolutely does. The independence is a very important, but to me, often overlooked point when looking at an investment manager. You want stability. You want the employees to be effectively be in control. in terms of direction of the firm as well as its investments. And I think, the independence, brings forth stability in terms of the portfolio management team as well as investment teams. The, employee ownership sort of, dynamic is also important as well. And I think, we're very, very proud to say that myself, as well as a lot of our sector heads and portfolio managers together, we collectively have worked together for essentially our entire careers, right? Well over, 20 plus years. And, that to me, that also goes into the performance. It's consistent. You don't have much turnover. And I think that to me is paramount when you think about DoubleLine and part of our strengths, right?
Without a doubt, that is one of the hallmarks of a great portfolio management team, is one that's been together for a long time and been through the ups and the downs and the battles, the good times and the bad times. So Morris, let's talk about commercial real estate, and to kind of set the stage, why has it been in the headlines so much the last couple of years?
Well, we sometimes joke around on the commercial real estate team side to say that CMBS and commercial real estate is the gift that keeps giving. And somehow we say that in a facetious sort of manner. But the reality is, if you think about what just happened in the last 5 years, we went through a global pandemic where the questions arise about the use of office, questions arise about, the use of retail and shopping behavior and all these sort of important market-oriented changes. And then you survived the pandemic. And then in 2022, we embarked on a 500 basis point interest rate hike. So as a sector, I can tell you that we've actually been through a lot. And, from the commercial real estate sort of ecosystem in itself, there's a lot of unique aspects about it. And the way I kind of look at it is, this is the only credit sector. If you just think about credit, fixed income instruments, this is the only sector that's actually gone through its own mini recession. We're talking about economic slowdown in the beginning as you're, thinking about the, macroeconomic environment. But I can tell you that for the commercial real estate industry, we've actually been in our own economic slowdown within our ecosystem. Prices are down. Office buildings, are down, some areas greater than 50+%. Apartments are also down from its peak, around 20% in terms of prices. And, I think even, assets such as industrial assets are, down about 5% as well. So I think all in all, there's a reset in valuation, which makes it somewhat of a healthy asset class as compared to some of the other credit areas where the cycles just much, much longer. So, that's kind of how I view things. You want to look at it as, what just happened? Well, asset reset and prices reset. And from an investor standpoint, how do we take advantage of that on a risk-adjusted reward basis versus other sectors? And I think that's really why we're talking about commercial real estate is the opportunities that we're seeing.
Absolutely. So to many financial advisors and investors, I think they're concerned about commercial real estate. It really goes back to COVID and everybody working from home or now hybrid working situations. So is the concern specifically about office buildings, or is the concern broader? And just kind of, again, to help set the stage for understanding commercial real estate, can you run us through what other sectors make up commercial real estate?
Yeah. So when we think about commercial real estate, there are office as a property type, so office buildings. There's retail, and retail, you can split that between, big categories are malls and or shopping centers or strip shopping centers. And then you can go into industrial logistics, so warehouses, right? The typical logistics distribution centers that Amazon would lease up and or, direct to consumer retailers would use so that they can deliver their online deliveries in a timely manner. They use up these industrial logistics facilities. That's been a very popular area. There's also apartments. You can't ignore apartments, essentially multifamily buildings, which is more of a housing play. And then as you kind of go into the other food groups of the commercial real estate, there's hotels, different flavors of hotels, whether it's luxury or something like a limited service hotel. And then there's self-storage. So between all of these, these are the different flavors of commercial real estate. And if you see these different flavors, then one can say, hey, it's actually not that bad. Office is bad, but are hotels really that bad, or are apartments really that bad? And I think what we lost from a market standpoint in terms of headlines is when you read headlines, over the last few years, it would say commercial real estate reckoning. Well, are you really talking about office, or are you talking about all these different asset classes, right? So that to me, I think, is the minutia details. When you speak with a professional, they'll say, well, actually, it depends on which building, where is it located, who actually owns it, what's the capitalization like. And so just as companies have stories, every building also has a story.
So big picture, can you talk about the current state of the commercial real estate market and about how recent economic shifts such as interest rates, inflation have really influenced the sector?
I think big picture wise, we went from we talk about sentiment. Sentiment was at its lowest in the spring of 2023. And we have been clawing ourselves back up in terms of sentiment. And sentiment to me leads to investment activity. And so what we've actually seen is effectively a bottoming of real estate prices, particularly during the fourth quarter of last year. And that's a culmination of rate cuts. That's also a culmination of factors, surrounding increased sentiment, more willingness to, for investors to do deals. And that's also a, result of asset prices actually being marked to market, right? You've got now, it's no secret that there are building values that are down. And so, the fact that the interest rates have come down a little bit and more willingness for lenders to provide capital, then you have the pieces of the equation for a market bottoming, essentially prices bottoming. So we're at the start of that up sort of specific trend. I don't think it's going to be a huge J curve per se, but I think the worst, at least for, what we observe, has been behind us in terms of property price depreciation declines. Sure, people can point to, well, what about that building that's just traded for 80% lower? I'm speaking more in generality. Again, every market, has its own dynamics. And yes, there's going to be idiosyncratic events where some buildings will continue to be in distress.
So what other challenges are you seeing in commercial real estate in areas like office space, retail, industrial properties, all of those different types that you've been talking about?
Yeah, I really think the challenges, aside from office is a dynamic where you have a shift of use and shift of use as well as repricing of that specific asset class. And I like to use that example of the required return for office went from 6%, essentially a 6% cap rate sort of environment, to now it's 8 to 9% requirement. So that yield annualized return has shifted. So that's caused the reprice of the specific asset class. Another sneaky asset class that's actually gone through a lot is really the apartment space in terms of multifamily. So I can tell you that multifamily, because of excess development that went on in the last few years, we're now seeing about 1.5 million units being delivered online across the country over the last 24 months. That 1.5 million units needs to be absorbed. They're built in markets such as Austin, right? On the surface, you can say Austin's doing well. I can tell you, because of the new supply, the rents are down, in the low to mid double digits type rent level changes. And that's a result of just overbuilt in an overbuilt market. So, you're seeing some signs of stress there where, those buildings need more time to lease up. The glass half full sort of dynamic of the apartment picture is that, yes, the values have reset lower, down 20%. But if you look on the other side of the equation, there's limited construction activity starting now. Banks aren't really providing loans for development. The regional banks themselves are still kind of hand-tied, nor are they willing to provide more credit into the space. So if you just let the cycle work itself out, we have a chart, but that we can show over time. But the point is, in 2026 and 2027, that supply picture actually diminishes. So if you believe that us within as a country we're undersupplied in housing, then these apartments will ultimately be leased up. and rents will start growing once they're leased up. And, I think in 2-3 years time, you're going to look back and say, wow, there's some buying opportunities there. And the debt on those properties will actually work itself out. So to me, the bigger picture, the elephant in the room is office, but the apartment space, it's going through its own thing. More often than not, it hasn't really been talked about. But that's also an area of development that, we can obviously go on and on about.
So we really basically talked about the challenges in commercial real estate. So let's talk about the opportunities. And you started touching upon that, but where do you see the most attractive opportunities in commercial real estate today? Are there specific sectors or regions you're focusing on?
I think from a opportunity standpoint in itself, coming off of the challenges, I think there are trophy office buildings that have been stress tested. And, to me, there are, bonds that are backed by some of these buildings where the market's just ignoring because of the recency bias in terms of the negativity of the office sector. But you've actually seen these buildings, and, I can tell you in Park Avenue corridor in New York City, when you walk down that corridor and you're actually talking to the brokers that are trying to lease up some of these buildings, they're going to tell you that it's really, really difficult to find large contiguous spaces within the Park Avenue corridor. If you want to be there, you're going to have to pay extremely expensive rent. So my point really are that there are areas, pockets of investment activity where bonds that are backed by some of these trophy buildings, newly built buildings, they may be mispriced, and investors like ourselves will be culling through the market to try to find those. I also think that there are investments to be made in the industrial logistics center sort of area where the warehouses themselves, the trade isn't going to go away, at least in terms of the shift from retail brick and mortar stores to online, and that dynamic will continue to expand. And then also grocery anchored shopping centers. It's a very simple back to basics type of property type where you saw how it did during COVID or the pandemic. We continue to see its necessity-based retail sort of dynamic play out. You always need a place to shop. You need some food. You need to go to a grocery store. And that dynamic, I think these are the type of plays where we're trying to balance out opportunity, but also think about what if there is a economic slowdown that's out on the horizon. And I can tell you that if you take that into account, you can still play offense in these areas that I touched upon, including apartments. Apartments are, housing isn't going anywhere. So,
Morris, can you walk us through the difference between investing in commercial real estate equity versus commercial real estate debt?
Yeah, I like to say that on the equity side, your returns can be effectively infinite. And I'm using that in a very, very loose term. On the debt side, the most you can get is interest. And your interest, that's contractually due, and your principal. And so from an equity side perspective, you're always thinking about, if I were to get into the equity of this building, how do I grow rents? How do I, extrapolate and grow value on this building so that I can exit and potentially sell this building in a manner where I can make a lot of money? On the debt side, for me, where we're investing in debt, we're really looking for, okay, at this point in time, the building is generating this amount of cash flow. What are the reasons and what are the risks to this cash flow stream? Can the rents go down? If it can, how much can it go down? What's going to drive the rents to go down? Who is the borrower? What are the risks of the borrower? So you're actually looking for all the things that can go wrong. Whereas on the equity side, you're looking for things that you can try to grow value. So when you're a debt investor like myself, you're always coming in with a bit of a skepticism because the most I can get is my interest and my principal. So, in a world where you're in commercial real estate, to me, that's where, understanding what your risks are relative to the return that you're going to get is extremely important.
So office space and commercial real estate has changed a lot, obviously, since the pandemic, with so many people working from home, even after a lot of companies have pulled people back to the office. So can you talk about what you think the future of densely populated cities is? Like cities like San Francisco, LA, Chicago, are they ever going to be the same again?
Yeah, that's a very difficult question to answer. I would say that's $1 million question. I would say that with time, everything can get back to normal. It just depends on what your time horizon is. So we'll start with San Francisco. San Francisco CBD has a finite amount of office space in terms of square footage. You really can't build, and the build cost is extremely expensive and cost prohibitive. And it's surrounded by a lot of venture capital inflows in terms of money, as well as educational talent, right? You have Stanford, you have Berkeley, UC Berkeley, you also have the South Bay in terms of all the strong tech companies. Within my own sort of personal opinion, I think San Francisco will come back. If there are buyers, if people looking at San Francisco in terms of wanting to buy into San Francisco from an equity side standpoint, you're going to make money in the medium to long term, so long as the city from a government standpoint doesn't make things worse. So that is how I look at San Francisco. Is just amount of, to me, I'm pretty optimistic is just based on my comments here. Chicago comes down to, you have negative outmigration, you have tax issues, you have municipality issues. You need the city to fix itself first before capital actually comes back in. And that to me will take a longer time. New York City, you're already seeing the advent effects in terms of return to office. And, I think the industries that are there, if you're dominated by financial services industries, the return to office will be much more robust. And so the makeup in terms of each city has its own pace in terms of return to normalcy, whether it gets back to 100% normal. I don't really have that specific answer, but I can tell you that from an investment standpoint in itself, we went from an area where these markets can't do any wrong to a world where they're uninvestable. And that was a 2023 sort of frame of thought. Now back to this, wait a minute, some markets are actually going to be okay. So, hopefully that answers your question, but I can tell you my response would be, it just depends on which market.
So a top concern for many investors right now is inflation. So a two-part question here. First, what does DoubleLine think of the possibility of inflation, increased inflation? And second, is real estate and commercial real estate a good hedge versus inflation?
Yeah, I think the prospects of inflation is a moving target at this juncture. I mean, you have a lot of tariff talk at this juncture, or tariff diplomacy is one way to kind of frame what we've been, seeing over the last couple of days. But I think inflation is a risk just based on the academic, logical effects of what tariffs ultimately do. There are repercussions of inflation, which implies economic slowdown. So, to me, the inflation dynamic, at least in terms of DoubleLine, we're recognizing the risk of inflation. But I think in the long run, if tariffs aren't handled appropriately, then the inflationary actually turns to deflationary sort of environment. So, we're trying to balance that, our views accordingly. Obviously, it's a very, very quick and moving target in itself. I think we're from a duration sort of thought process perspective, we're definitely not extending duration to say the least. But hopefully that answers your question in terms of how our view. We're trying to be as pragmatic as we can.
Yep. So you manage a significant amount of commercial mortgage-backed securities, or again, CMBSs at DoubleLine. Can you explain how these work and how they fit into an investment portfolio?
Yeah. So commercial mortgage-backed securities, they're either backed by one building, one loan, collateralized by one building, or it's a pool of loans that's collateralized by multiple buildings across multiple different geographic locales. And so from that specific concept in itself, as a bondholder, what we own is a piece of the mortgage underlying a specific building or a pool of buildings. And, as we look at these commercial mortgage-backed securities investments themselves, it, at the end of the day is a way to buy a piece of a loan on a building, ultimately. So the benefits of CMBS is that you get diversification. If you buy a pool of loans, a pool of loans, or you get diversification from just, traditional corporate credit. So the benefits of this commercial mortgage-backed securities specific as an instrument is there are traditional fixed income credit instruments such as corporates and or high yield. If you jump into the commercial real estate world, you now get exposure to a commercial real estate property, whether it's a hotel or a self-storage building or a grocery anchored shopping center. Right? And we can go on and on about the different property types. But that diversification is also rewarded with excess yield or excess spread for coming into this space where it's not traditional relative to what we view corporates are as a traditional instrument. So at the end of the day, it's a different alternative commercial fixed income instrument that investors can invest in. It's traded on a day-to-day basis. Liquidity is actually very, very strong as well. If you understand that sort of specific dynamic, you can actually put together a portfolio that generates excess yield on a similar rating basis to the tune of 50 to 100 basis points relative to the similar rated corporate bond. So that to me, I think is why investors are investing in CMBS. It's also part of the Barclays aggregate index as well. So it's an index sector. It's just not as popular as corporate credit.
All right. So you've just given us a clue on your answer here, but what is your current outlook on CMBS and what's the role they currently play in the strategy you manage?
Yeah, I think the outlook is it's still very positive. It's more so on a relative value basis, right? I'm not here to tell you that it's very, very cheap versus on its historical sort of viewpoint. But I can tell you that, in an environment where investors want fixed income, but then they look at the yield that a corporate bond or is generating, you can actually come to the CMBS market and buy a similar risk, similar rated bond and pick up that excess yield just by coming into the commercial real estate space. And I think that relative value proposition for CMBS is very real on its historical basis. It's also trading about over the last 10 years, it's about the 40 to 50 percentile range in terms of spread history. And that's also due to a culmination of factors such as the pandemic, as well as the interest rate hike and the 2023 regional banking crisis. These are all reasons that led to CMBS market being wider than corporates. And to me, those concerns, as you're asking me about questions about commercial real estate, they're still there. People are still lingering, but investors like ourselves are picking apart the market to extract value, and I think that's really important. For investors that understand these type of investments, there's actually very, very sound investments where you can get paid excess spread and also be in a very safe sort of vehicle.
So I think you've touched on this a little bit already, but what can you tell us about the status of private real estate debt markets?
Yeah, so the public side of real estate debt is primarily in commercial mortgage-backed securities. Yes, there are REIT corporate debt as well, corporate debt, REIT issued corporate debt. But I think for the lion's share in the public market, it's really just CMBS, commercial mortgage-backed securities. Jumping into the private side of the world, the private side, it's a vast market that's dominated by insurance companies, private debt, private credit funds, as well as small real estate debt funds. And when I say it's dominated by these type of investors, these investors essentially are making loans themselves in a very bespoke, customized solution. Traditionally, the insurance lending is about 30% of the real estate debt market. And we talk about commercial real estate debt from a universe standpoint, it's a close to a $5 trillion market. So 30% of that is in the insurance company sort of mandate or insurance company balance sheet. So insurance companies essentially would take your premium dollars that they receive, take that money and go out and lend to owners and operators of buildings. Away from that, the private credit vehicles themselves also are a source of capital. And I think we're at this juncture where, because banks are pulling back from lending, insurance companies are still lending on that side, but the ability for private pools of capital to come in and disintermediate the banks, that is a very, very real proposition. And I think that is a story that's developing at this juncture. There are a lot of private debt funds that are out there that are looking to raise capital to go lend. And I think that part of the cycle will continue to play itself out, right? We saw the public markets sell off first, spreads widen, CMBS was very, very cheap. Spreads have come in a little bit, and now it's the private sector world. The private market is now waking up now that the public market got to move first. So we'll see that story play out. I do think there are relative value opportunities as well as a lender. If you want to go out and you want to lend, and you have the capital to do a private deal and lend to borrowers, you're going to find a lot of opportunities on that front. Again, it just comes down to what is your risk tolerance and what also what liquidity provisions would you like?
So for advisors who are trying to build diversified portfolios, how does commercial real estate fit into that, and what role should it really play for individual investors?
Yeah, so speaking from the debt side, if you want, the commercial real estate will give you credit exposure to the credit market through commercial real estate loans. There's excess spread, gives you diversification relative to corporates, as I kind of mentioned earlier. And also from an economic standpoint in itself, I can tell you that from a asset side perspective, your loan has an asset. There's a tangible investment. There's a building tied to it. So that building in itself also provides a sense of protection from a debt holder perspective. So these are all the benefits of it. I think the use case for CMBS or commercial mortgage-backed securities are to, as a diversifier within portfolio to get excess spread. I think that's the primary use case. I mean, I think some investors have different use cases in terms of wanting to get exposure, but that diversification plus excess spread is, to me, the main point that I would get across.
So Morris, you made a compelling case for the consideration of commercial real estate as an asset class. I think you've also made a good case for why you'd want an experienced team using active management to manage a portfolio around commercial real estate.
All right. Well, this has been a great conversation so far. Lots of really good information for our listeners. So thank you for that. But before we let you go, we do have a few more questions that we like to ask all of our guests here on the Weighing Machine. And the first is, what is currently your favorite investment idea?
My favorite investment idea, self-storage. And unfortunately, it's a commercial real estate centric sort of investment. And I was thinking about this a little bit more. It's just storage properties, whether you get exposure through equity, self-storage equity REIT or whatnot, or directly direct investment. It just depends on your personal preference. But to me, the premises and logic behind it are, in a stagflation and or a recessionary environment, a storage property should benefit in the long run because a few points. Stagflation, rates are high, growth is low, which implies the barrier to entry for home ownership will likely continue to be challenged, which then means people are forced to go to the rental market or downsize into the rental market, which means that the excess items that you would have when you're downsizing, you need to store it somewhere. So to me, the storage sort of play, that's one aspect. In a recessionary environment, again, it's a downsizing sort of theme. You'll probably need to downsize. You could presumably move, but that storage property will likely benefit as well through that sort of environment. So it's somewhat resilient. Only point where it doesn't do well is in a high growth environment where economic expansion and activity is 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 very, very robust. So I think that's to me that's been on my mind recently. Whether for personal investment or whatnot, but that's front and center.
It's funny you should say that. Just before this podcast interview, I was told I need to find some self-storage. I just had a water pipe freeze and break, and it took out my kitchen floor and my basement. I was told I need to move all my furniture out. So there it is.
Oh, no.
I'm already helping you in a very small way. But so in our profession, we have an obligation to perform at a high level. So Morris, how do you maintain your health and your energy, both physical and mental, to make sure you're performing at a high level each day?
When you have three little kids under the age of 8, I think that's one aspect. Or that's enough motivation. For me, honestly, really staying active. I work out pretty religiously in terms of doing exercises and fitness, functional fitness, being outside and outdoors whenever I can. I think these are all things that for me, how I keep my energy up. Just staying healthy and eating right. I think those are basic tenets in terms of foundation. Easier said than done. I myself can be challenged at times, but those are core principles.
Those are good ones. All right, here's another one for you. In this age of information overload, how do you balance the need to be informed and educated with the need to reset your mind and tune out?
I think there are use cases for audiobooks. There are use cases for AI type software like ChatGPT or some of the more popular AI type software where you can get a quick summary and learn about something in a quick manner. So to me, I think what I've actually find myself is back then I used to Google a lot. Now I'm starting to be a little more smarter about the questions I ask and the answers I get, whether it's through audiobooks or some of the AI software, at least in terms of learning about things. These are ways to kind of cut down on time and screen time. Yes, I recognize the interface in terms of being on technological platforms. Those are should be a fine balance. So my other point is it kind of goes back to put your phone down once you've gotten what you need, and go out and go do something active, right? I think that's always important. I mean, investors like ourselves that are market facing, you have so much information at your fingertips, and I'm sure you already know from time to time what's going on. Sometimes it's good to just have a break and go out, go for a run, play some golf and take some time off.
Good advice. And information detox, absolutely. So Morris, you have been around so many successful people who have helped you get to where you are today. So who are some of the people you are professionally thankful for?
Yeah, I think, the person front and center, our CEO, CIO, Jeffrey Gundlach, as I've been working my whole career with him, I think, his the things that we've learned from him, myself included, it's timeless. These are things that I can say that I couldn't be here without him. Just his guiding principles in terms of what I've learned from him. So, professionally, that's on that front. And obviously we all have a, core group of friends as well on the personal side that, helps with personal development. I'm a big believer in you are the average of your 5 best friends. So as you kind of think about, what that implies, you really become the person you are, you really become, that person based on who you're hanging out with. So I'll kind of drop those points out there for people to kind of digest, but that's how I like to, be thankful in terms of both professionally and on the private side.
One quick comment on Jeffrey Gundlach. It was about a year ago. I was lucky enough to interview him on a big stage, maybe in front of 1,000 advisors. And the one thing that was interesting, it was a great interview, obviously. He was great. But there were dozens of advisors in the front row looking at him like they were at a rock concert. So, he's followed by many, and you're lucky you get to interact with them each and every day. It's pretty cool.
Yeah. Something we're we're definitely very thankful for, but I'm not surprised.
All right, here's another one for you. What are you reading, watching, or listening to at the moment? Do you have recommendations to share for our listeners?
Yeah, listening to In Good Company. It's a podcast that, is hosted by Nikolai Tangen, the CEO of Norges Bank, or Norges Bank. They have some really, really good guests, to the extent people are interested in hearing from a lot of world-renowned guests, that you can get a lot of insights from there. In terms of reading, recently I just read a book about Genghis Khan, and I can tell you that kind of gives you a lot of, different history sort of context in terms of how the world was shaped during that period by the Mongols. I think these are things that, to me, like, stick out front and center. I'm more speaking just based on recency in terms of what I've read.
Pretty good stuff. All right. Well, Morris, thanks so much for coming on the show. It's been great to chat with you. Before you go, tell us how can our listeners stay in touch and learn more about what you're doing at DoubleLine?
Yeah. So, obviously we have a lot of, DoubleLine content, whether it's white paper and or fun facts on our website at, doubleline.com. There's a contact as well on our website that, people can use to reach out to us. And, I'm sure, we'll try our best to get back to everyone as soon as we can. But I appreciate everyone's time. And Rusty and Robyn, thank you for having me. It's been a pleasure over the last hour.
Morris, again, a very compelling discussion, what I think is a very important asset class. I also would argue an underappreciated asset class. I think the one that deserves both strategic and tactical considerations by investors. So thank you for your time today. It was very useful.
Thank you.
All right. Well, that's going to do it for this week. Rusty, take us out with your final words.
Invest well and be well.
We'll be back soon. Thanks for listening to The Weighing Machine. And if you liked this episode, please remember to subscribe. And thank you for your time and trust in Orion.
Thanks again for listening. Robyn and I truly appreciate you giving us some of your valuable time. We hope to provide you in each episode something you can use in conversations or making decisions or both. If you like this podcast, you might also like some of our sister podcasts here at Orion. First, we have the Weighing the Risk podcast, which I co-host monthly with Nick Cadola on behalf of Orion Risk Intelligence. This is where we consider various market scenarios regarding top-of-mind concerns among financial advisors and investors. Next, we have one of the top-rated and most popular podcasts in the financial industry, especially when it comes to behavioral finance, Dr. Daniel Crosby's weekly Standard Deviation podcast. For more, including commentary, videos, and other great content, please check out the website, orion.com. Go to the resources drop-down menu and find me, Rusty Vanneman. Here you should find a wealth of content created just for you under thought leaders. Thanks again, and invest well and be well, and we'll talk to you next week.
The Weighing Machine is hosted by Rusty Vanneman, Chief Investment Strategist at Orion, and me, Robyn Murray, freelance writer and editor. If you have feedback or questions about our podcast today, please send us a note at rusty@orion.com. All opinions expressed by Rusty Vanneman and our podcast guests are solely their own opinions, and they don't reflect the opinion of or endorsement by Orion, its affiliate subsidiaries, and its employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.
Wealth management services are offered by Orion Portfolio Solutions, LLC, doing business as Breaker Capital Investments, a registered investment advisor. Orion Portfolio Solutions, LLC is a wholly owned subsidiary of Orion Advisor Solutions, Incorporated.